Hi, this is Soumya Sarkar from Wealth Redefine. Today with me, who requires no introduction, Mr. Harsha Upadhyaya. You all know, if you have been investing in mutual funds, that he is a CIO of Kotak Mutual Fund. My association with Mr. Upadhyaya has been long, since I started in 2013, and I've always been following his investment philosophy and principles. I've been fortunate to meet him for several times, and this time it is my fortune that he has agreed for this podcast. Thank you, sir. Thank you for joining.
Thank you so much, Sam.
Thank you for joining us. I've been following you since long, and sir, I know your journey, but most of the people do not know your journey from UTI to DSP to Kotak, and in a Kotak you become one of the star fund manager since long. So, sir, if you can describe slightly about your journey in this in mutual fund industry.
So, after I completed my post-graduation in management, I came to Mumbai and joined UTI as an analyst. Many of you may not remember that stint because that was the early part of journey. So, after UTI, I also spent some time in some of the sell-side brokerages doing sectoral research, right? And then moved to UTI back later on to actually I started another journey in research as head of research in UTI. It so happened that there were a few new funds that came up around the same time, and there was some attrition in UTI. So I got the opportunity of managing one of those funds at that point of time. So my fund management career started in 2006. And thereafter I spent about another five and a half years in UTI managing multiple funds, and then joined DSP BlackRock investment managers in 2011. That time DSP and BlackRock had a joint venture. So I joined them, and I worked there for about a year. That is when I got the offer from Kotak Mutual Fund to head their equity team. So since it was a leadership role, I decided to join Kotak, and thereafter, last almost 12 years I've been with Kotak.
Yeah. So, sir, you have joined almost in 1996 kind of a time in UTI, which you told me. And right now we are sitting at 2024. What you have seen as a journey for a client's perspective in that mindset? 1996, we just came out of the Harshad Mehta scam, Ketan Parekh scam was just coming in, and then 1999 we had a nuclear blast and a lot of money had been taken out. US put a lot of sanction on us. 2004, Bajpayee government came in and market started flying. So, sir, how you have seen the client mindset has changed?
See, clearly one thing that everyone who has been in the market for that long will understand that India has been a great market for investors, right? There have been several ups and downs. You mentioned some of them, but there have been even more than that. For example, global financial crisis, the COVID bust, impact, .com bust, the terrorist attacks, all of that. So what comes out clearly is, as long as the economy is doing well, as long as the corporate profits are growing, if you have a good fund managers managing the money, then you are bound to create wealth for yourself, and that wealth can be phenomenal after compounding for so many years. In the initial period, as you rightly said, there were more downs than ups in terms of our economy, in terms of our corporates, etc. But now we seem to be in a very, very sweet spot as far as growth is concerned, as far as corporate landscape is building up. So to that extent, it's become much easier for us to really talk about equity as an asset class today. I don't think you need to spend too much time convincing investors about the benefits of equity investing. But at that point of time, obviously, it was a hard sell because there were more visible negatives in front of us at all points of time, right? And also the awareness about equity as an asset class was much lesser. So I would say we have traversed a long way, and somewhere in the last 10 years, I think industry has also done a wonderful job in terms of creating awareness around SIPs. Now you don't need to really talk about benefits of SIPs to investors anymore. People know it themselves. It's become a habit, and a very good habit in that sense. So I think it's become a lot more easier, I would say, to actually talk about equity investing and its benefits in that sense. So definitely a good sweet spot, I would say.
Sir, do you think that we are getting into more of a equity culture Because American, if you see at American, there is approximately 60% households into equity investments. In India, it was something around 3-4%. But over the period of time, now I can see the recent data which has come that now almost 23% of the money which is there in FD is out of that 23% is almost AUM is now in the equity market, when in the mutual fund, not exactly on equity market. But sir, I've seen a lot of clients who are now doing SIPs.
Correct.
So do you think that equity culture is slowly, gradually entering into India, and India is moving from a Gavaskar era to a Kohli era where we start playing more aggressively?
No, I think SIPs have become part of equity investing culture. A lot more people are understanding and have understood the benefits of SIPs. As you rightly said, the penetration levels are increasing. But if you look at the overall penetration levels, even after all of this, is really, really small yet. So I don't think we have reached anywhere towards the levels that US or even some of the other emerging markets like Korea have reached in terms of the equity penetration. But definitely it's been better than what we had seen 10 years earlier. Today there are about 7 crore folios in SIP accounts, for example. And usually we know that whenever somebody invests, they invest across multiple mutual funds. And generally in a household, there would be at least 2 different individuals who are investing, or maybe slightly more than 2. So to that extent, the unique households who are really investing through SIPs among the investable households is still a small number, I would say. But if you look at the kind of growth that we have seen, 3 years back, probably our SIP numbers were in the region of 8,000 to 9,000 crores per month in terms of input number. Now we are already at 18,000 crores per month. So definitely not only the new account folios are getting created, but also the amount that is coming through some of these SIPs are also increasing. So definitely a good trend. But if you can reach those levels of Korea and US, I think it will be fantastic. Maybe it will take several more years, but definitely the journey has already begun, I would say.
Now sir, come to the fund which you are now managing, sir. I remember you fondly about the Kotak Select Focus, become Kotak Multicap, and now Kotak Flexicap. But sir, after Kotak Flexicap, it's Multicap, the SEBI come with the Multicap categorization and all those things. You have to change it to Kotak Flexicap. So you have seen some, sir, not able to beat the benchmark in the Kotak Flexicap. What do you think about it, sir? And do you think, sir, that it will overcome the challenges which it has faced under your guidance and leadership?
Definitely. When we look at the near-term performance, maybe there is a underperformance against the benchmark. But we should also remember that when you have funds getting managed for a long number of periods, there will be periods of underperformance, outperformance, which is very natural. But has anything changed in terms of the investment philosophy? The answer is no. You mentioned about the change of name. Yes, definitely the name has changed. But there has been no change in terms of the investment discipline or the philosophy that we have followed under this fund, right? That is point number 1. But yes, there are cycles. Some cycles are favorable to you, some cycles are unfavorable to you. But if you look at the overall long-term performance of the fund is still one of the strongest performers in its own category, I would say. When you talk about underperformance against the benchmark, you should also remember what has happened to the benchmarks. For example, when we started this fund as Select Focus, initially the benchmark was Nifty 50. Then it became Nifty 200. Now, with the regulator asking us to change the benchmark for the entire category, of course, the benchmark has become NSE 500 total returns. What it means is, when you look at the performance of today, you are also looking at past performance with the same lenses, right? Initially, it was not benchmarked against NSE 500, which is a wider basket, which has more of mid and small caps. So obviously, in a bull market, as we are witnessing today, the performance of NSE 500 is much better than, let's say, NSE 200 or Nifty. But unfortunately, unlike in the international markets, whenever there has been a change in a benchmark, they compare from that change, from that date onwards, whatever the change has happened. In Indian context, however, we compare it with the new benchmark but even the earlier performance, which is not fair, I would say, because we were never benchmarked against NSE 500 at that point of time. So sometimes how you actually look at the performance also kind of creates this confusion in the minds that fund has been underperforming for long. But in those periods, we were never benchmarked to NSE 500. The ideal way to look at it is, as long as it was benchmarked to NSE 50, how it had performed. As long as it was benchmarked to NSE 200, how it had performed, and how it has performed in the recent times when it
NSE
is
500.
NSE 500. If you make that analysis, I think the period of underperformance will be even smaller. And I'm not saying that active funds will always be able to outperform. Yes, that is the endeavor, but you will always have challenges, cycles. What matters is over the long term, and anyways we propose equity investing as a long-term investment theme, as a class. One should be looking at longer term performance and with what consistency one has managed the fund, and whether there have been any sleepless nights for the investors. And if you look at all these events that you mentioned over the last several years, in all of those events, for example, Kotak Flexicap or whatever it was called earlier, has always stood out in terms of reducing that drag.
Yeah.
So our focus is to make sure that we don't make too many mistakes, and at the same time we want to create wealth over the long term in a sustainable fashion. So that's been the philosophy, and that continues. So I would say investors who are looking for a kind of a conservative fund management and who are looking at a stable portfolio and want to create wealth for the long term, the fund is definitely one of the choices one can make.
So in a Kotak Flexicap fund, we have seen that you have a very high proposition of large cap, because it was been from select focus onward, it's maintained the kind of the same philosophy of having a high proposition of the large cap and a reduced proposition of mid cap and small cap. I think even small cap is slightly higher, but mid cap was much lower in terms of assets. Sir, do you think that because of the recent mid cap and small cap rally, which was barely unexpected at some cases, that actually has taken the fund against the benchmark difference, or it has been that my understanding is that Kotak Flexicap will always be that kind of fund which will be more of a large cap trend, because it should be like that. But because of these kind of a small cap rally, and suddenly obviously the comparative things have gone up, so that is the reason it's showing underperformance. Do you think, and could it be, sir, it is a strategic decision to take that I will continue to be on a mid cap and small cap on a lower proposition?
See, first of all, how did we position this fund to the investors? We always positioned this fund as a Flexicap fund with a tilt towards large caps, right? And there is a reason behind that. When you look at very long term, I am talking about 10-15 years, having a conservative asset allocation in terms of a broad range always helps, because it's easy to say that you can move from 0 to 100 from any bucket to another bucket, but in practical terms it's very difficult. It's like timing the market, it's never possible. So we realized that very early, and we always said that this will have 65 to 75% going into large caps. Even when it was called Select Focus or Kotak Multicap, it was the same philosophy. The reason for that is, in this fund, the investment premise is built on the fact that at different points of economic cycle, there are different sectors which are likely to outperform the market average growth and performance. Our focus is to take those particular sectoral views from a top-down perspective and then complement that with bottom-up stock selection within those sectors. If that is the case, the fund is going to be deviating from the sectoral positions vis-a-vis the benchmark at most points of time compared to a normal diversified fund, right? And when we are doing that, already we are taking certain amount of risk in the fund. If you add this market capitalization movement from one market capitalization to another, then that would be an additional layer of risk to the investor. So we thought that yes, we will move market capitalization mix, but only in a range of, let's say, 10%. So 65 to 75 for large caps always, and the remaining going into mid and small caps. Mid caps have always been between 25 to 30-35%, and small caps have always been less than 5%. This is how we have positioned the fund across cycles, across time periods. So it's not that when the fund was small, it was taking more of small cap names, and now it is not. That's not the case. So we have been very consistent in terms of our investment discipline, and we have clearly communicated this to investors as well. So yes, coming to your second point, yes, there has been a strong rally from the COVID lows in the market capitalization buckets of mid caps and small caps as compared to large caps. While we have probably caught that in large caps and mid caps to a reasonable extent, the rally in the small caps has gone against the fund, because as I said, historically we have held this notion of keeping a 0 to 5% in small caps, and small caps in the past used to outperform, but outperform in shorter cycles and to a lesser extent, right? But this time it has been very, very different, where it has consistently outperformed and outperformed by a larger margin. So to that extent, any fund which had a higher proportion of small caps in the fund obviously would have got that benefit. We have not got that, but we are not going to chase that momentum and take higher small caps at this point of time, because it's also a call about the valuation comfort. As Kotak Mutual Fund, we do believe at current juncture, the large caps offer relatively better valuation comfort as compared to mid caps, and definitely as compared to small caps. So that's the reason for continuing this asset mix, and we will wait through these challenges, and we have done that in the past as well. So that's what I would like to say.
So as Mr. Upadhyaya has said, please understand for the clients who are actually keep on asking us about this Kotak Flexicap, it is not always the chasing the return. You have to mitigate the risk also. And Kotak being one of the best performer in the industry, because it has not only chased the return but also mitigate the risk. Equity investment in the longer run will always benefit you if you are positioned yourself against your risk properly. It cannot be only the chasing the return, because once the market starts coming down, which will eventually happen any point of time, it has happened in all matured market, it will happen also in the emerging market, then you will understand that how only chasing the return may not benefit you. Rather, you should move equity as a much more stable investment for a longer period of time. Sir, now come to the part of the ESG fund, sir.
Yes.
ESG funds, sir, has faced across benchmark even, ESG funds have faced challenges, sir. So, can you elaborate, sir, what are the factors influencing the challenges towards the ESG funds, and how you see, sir, in future as a ESG?
See, what has happened is ESG index is a nuanced index where a certain industry segments get a higher ESG rating and hence have a higher weightage in the index. It is very different from your any other broad-based index. For example, it's very different from Nifty or NSE 500 or any other benchmark that you look at. Naturally, environmental issues are less for banks and IT sector, right? And generally they rate very highly on overall ESG rating. So to that extent, banking and financial services and the IT sector have the highest weightage in the ESG index. At a point of time, these two sectors were doing much better than the rest of the market, and hence the ESG index on the past performance basis was looking much better than Nifty, for example. But today when you do that comparison, since most of the other non-banking and IT kind of sectors have done very well since the COVID lows, the performance of the index, ESG index versus Nifty, for example, looks lackluster, right? So that's point number one. Second, when you look at our own ESG landscape, that is still evolving. The regulatory disclosures are increasing. There have been few changes that have come in terms of how investments can be done. So one of the constraints that we faced after launching the fund, for example, is the regulator made it mandatory for us to look at investing in companies which had published BRSR reports in the annual report. BRSR means business responsibility and social report, BRSR report.
Yeah.
So when it was not mandatory in the Indian context, we didn't see too many companies adopting it, but it was already required for our investment purposes, which meant that the universe that we had became very small. So we could not really change the portfolio too often. Had we sold something which we were already holding, then we had to look for company which had already published BRSR report. So to that extent, that became a constraint. Right now, it's not a constraint because there are 1,000 companies which have published BRSR report. But the challenge has been more on the banking financial services, for example. It's been doing much lesser than, let's say, many of the other manufacturing segments as a sector. So to that extent, having higher weightage in the index, ESG index, also leads to lower performance of ESG index as compared to Nifty, for example.
So, sir, in the ESG exclusionary fund, you have a 80% exposure in the large cap, whereas other funds in the same category have around 50-55. So, do you think that that large cap is going to give that kind of return in next 2 years or 3 years of time, where it can actually, that means sir, if you are holding 80%, that means you are bullish on it. But what are the contexts are there that you are bullish on large cap? Is it because the valuation, or is it because some cash flows which is going to come on the large cap? Whatever, sir, you think.
So one, clearly from our relative valuation levels, large caps are at much better valuation levels. I would think that even if there is any external shock, or if there is any correction for whatever reason, the large caps will offer better risk reward ratio at this point of time. So across our funds, wherever the mandate allows, there has been a tilt towards large caps, and that goes the same for even ESG fund. But it is not at 80%, it's probably at about 70 odd percent at this point of time. So we keep evaluating all the companies that are eligible for coming into the portfolio, and then we make a choice in terms of what is the expected growth and what are the valuations that we are paying for those companies. So at this juncture, since our house view has been to have a slight tilt towards large caps and slightly lower weightage to mid and small caps, that's what comes in even ESG fund. And one more thing to remember in ESG fund is we also need to keep an eye on the ESG ratings, and generally some of the larger companies have done better work on the ESG side. So to that extent, the ESG rating is also higher for the large cap. So that also gives a little bit of tilt towards that basket in the fund. So that's how it has been constructed.
Sir, around 6 months back, I had the opportunity to talk to Mr. Shah, who is managing the Edelweiss Small Cap Fund. Okay. I asked him about that point of time, the valuation of small cap. He said, no, there are still some rooms and all those things. And actually, sir, it worked. So 6 months back, when I was thinking personally that yes, the valuation probably had the roof, but I find that yes, it has gone up again. Sir, as a CIO of Kotak, what is your view on mid and small cap segment as of now? Because valuation wise, I find it quite difficult, but again, clients are more inclined to it because the past return has shown some extraordinary returns. So what is your take on that, sir, on a segment, on a specific?
See, first of all, one should never look at past returns and extrapolate that to happen always.
Yeah.
Right? It may have come in the past, but it may have been because of several other reasons.
Yes.
So when you are looking at past 3 years, for example, you are looking at a period which has been from COVID lows. So to that extent, one, the entry level valuations were very, very attractive, and the earnings growth was also much better than what the market anticipated at that point of time. So both factors have led to a kind of abnormal returns in these two segments, mid and small caps, more so in small caps, for example. And consequently, the valuations have also moved up, as you rightly mentioned. Now, when you look at large cap valuations, they are probably about 5 to 6% premium to long term averages. While they are expensive, I won't say that there is too much risk of losing money if you are a long term investor. With some shallow correction, with some time correction, you should be able to wade through that volatility. Or even in case of an external shock and markets taking a knock, you are not going to see a sustainable downtrend there, and you should be able to come back in terms of performance. However, when you look at mid caps, for example, they are trading at almost 20-22% premium to their long term average, and much higher than large cap valuations. Small caps, again, they have been trading at a valuation which is higher than that of large caps, and also trading at almost 45% premium to their own historical average. So to that extent, today there is no problem. The earnings delivery of mid and small caps has been higher, and higher by a significant margin as compared to large caps. So this valuation differential, one can still, if you are a really optimistic person, can justify. But in case there is a knock on the earnings trajectory of mid and small caps, if that differential that I mentioned narrows, or if they start to grow at a pace lesser than that of large caps, then the current valuations cannot sustain. Right. So that is where I believe the margin of safety, as we call it, is much lesser in case of mid and small caps, given the valuation spike that we have seen in the last 3 years. So it's not that you will not make money in mid and small caps, but if you are entering, you should enter with a more moderated expectations, not just looking at past returns. Second, last 3 years have been very unusual. Hardly there has been any downside volatility. And we know that equity investing is not always so easy. There will be cycles. So you should be prepared for higher volatility, especially as you go up in terms of valuation. So my message to investors who are looking at this segment is, one, you should have a more moderated expectation of returns going forward, and also you should be prepared for higher volatility. And generally at this valuation, we would advise a slight tilt towards large cap. If you are still making investments in mid and small cap funds, you should remember that a staggered approach will be better rather than lump sum at these valuations.
Right. So it is like more of a, you can, if you want to go for a mid and small cap, you should have a longer horizon first
Correct.
of all, and a staggered way would have been a better at this point of time. So now I come to the global economy part. What is your take on this global economy at this point of time? China returns in last 3 years has been negative. Not negative, is massively negative. US may come to the recession, that they are not, inflation is still not good enough to cut the rates by Fed. Japan has already declared into recession. So what is your take on global economy? Japan is in recession, market is hitting the new highs in Japan. So what is your take on this mixture parts of global thing right now? US may go into the recession, inflation is higher, but market has gone because of Nvidia, massive results. So what is your take on overall thing, and where do you see India as in this context?
So clearly when you look at global economies, there are several challenges. You mentioned some of them. One, subdued growth. Second, high inflation, and ability to cut interest rates is minimum, all of that. So in that context, I think India definitely stands out. We call that as oasis in the desert. In spite of all of these global challenges, India continues to do well in terms of growth. Inflation is also a lot more moderated at this point of time compared to our own history. And also, I think at some point of time in the near future, there is room to cut interest rates in the Indian context. So India, I think, despite all the challenges, is doing much better. As far as other economies are concerned and how the markets have performed, there may not be one-to-one correlation always in terms of how the near-term economic outlook looks and how markets behave. Many a times, something which is going to happen in the future is already priced into the market. So at many points of time, at the bottom of the cycle, sometimes people start believing that the cycle is going to get over and start buying into the asset class. Probably that is happening in some cases, or some of the expectation may not come through in terms of how economy is going to behave, etc. So it could be multiple issues, but definitely I think India stands out in terms of its strength at this point of time. And that is also one of the reasons why the foreign interest in India is also increasing. You mentioned about Chinese market not making money for investors in last 3 years, but you will be surprised, from 1992 onwards, any investor in China in USD terms has not made returns, right? So it's a 30-year period with zero returns in that sense. So yes, there have been cycles where returns have been made in Chinese markets, but because of what has happened in the recent times, overall long-term returns have been very, very muted. So that's also driving more flows into other markets which are competing with China, and India definitely happens to be one. So net, I would say India has been doing much better than many of the other global economies, and continues to attract more attention.
Okay. So, government has now, we can see this government, especially this Modi government, had invested promoting defense. Is one of the defense was not in our priority list till 2013-14, and now we have seen the defense has come up. We have seen renewable energies are come up. Solar panels are going to be installed. This has been already declared in the budget. So, do you think, sir, that which kind of companies can get benefited out of it, or which sectors can get benefited out of these things? Like, sir, is it a steel sectors which is going to benefit it because there is a lot of defense things which is going to come, or it is more of a, sir, that solar things, or it is more of a chemical companies which are more benefited? Which sector rather?
I would say manufacturing as a theme is seeing a lot of traction from a policy momentum perspective, and also the requirement of additional capacities across sectors is very visible. Yes, you mentioned some of the segments where there is a renewed interest in terms of government policies and momentum. Definitely some of them, defense equipment manufacturing, railways, and many other segments of manufacturing are going to see a lot of momentum, I would say. And there are multiple opportunities. The valuation may not be similar in all of these segments. You will always have to look at valuations and also expected growth at various points of time. But I would say manufacturing as a theme is something that one should consider. India has seen very, very long cycles of not only very good business performance, but also stock markets tend to follow a certain cycle for a considerable amount of time. I would say from late 90s to until the dot-com burst, for example, it was IT outsourcing was a theme, right? Not only businesses did well, but in terms of stock market wealth creation, that was a theme that really did well. Then you had a period where infrastructure construction related activities and their beneficiaries really participated. Then you had banking and consumption kind of driving the markets for next several years. Now probably is a period where manufacturing could be that particular theme, and all the building blocks seem to be coming in place, not just the policy environment, but also the need for higher capacities, the ability of India to really manufacture various products, and also ability to market them in the global context. And all of this mean that this particular theme can run for next several years. And if that happens, definitely there is more money to be made in this theme. Okay. So we definitely are very bullish on the manufacturing theme.
Okay. Sir, as a fund manager, why do you see AI and ML is influencing your decision? Is it still based people-based job, or you think that AI is going to take over some of the?
See, technology as it progresses, it will definitely have positive implications on
now,
every aspect of the business. So it will have implications on investment business as well. We are taking baby steps on many of these, not exactly AI or ML, but definitely we are using technology as a tool to improve our efficiency on research, our investment related decisions, etc. Sometime in 2023, we launched a Kotak Fund, which uses an algorithm to really choose stocks and assign weights to it. We have also built in boundaries in terms of our own investment knowledge in terms of what not to do in that particular fund. So once that is built, the boundary is built, then the algorithm decides which are the stocks that need to come into the portfolio, what are the weights to be assigned. So it's a baby step that we have taken. We launched this fund sometime in the middle of last year. It's been a very short period of time, but in the initial period, there has been a reasonable success, I would say. So we are taking a few steps ourselves in terms of embracing technology to improve research efficiency as well as investment decisions.
Sir, on a client's perspective, I would just last two questions from my side would be that there are a lot of clients who are going back to the 5 years return. They are investing the money on their own through the direct, and probably when there is a correction happens, they get slightly bothered or uncontrollable for themselves, and they redeem the money and go. Another way of creating the wealth is through taking the proper advice, do it on leave it to him, consult on a regular basis, and invest the money and create the wealth. What is your take on that part, sir? That people who are direct doing it without having this knowledge, only looking at 5 years or 6 years returns, because beyond that they don't see anything. How do you take on that part, sir?
Yeah, as I said, going completely by past returns is not the right way to invest for the future. Right? It's not as simple as that, and the cycles are different. So what has given returns in the past may or may not give returns in the future. So that's where I think if you are not able to analyze fully, if you are not able to devote the time that is required, it's not a part-time job, it's a full-time job. If you are able to do all of that, and if you have a skill set to do that, yes, please go ahead and do it directly. Right? If you don't have all of that, it's better to go for a professional advice and at least make sure that you are not making mistakes. Because in a bullish market, even when you are making mistakes, probably you are still earning some return, right? Because even worst of the decisions will give you some positive return. So you will not understand the real gravity of making those mistakes. But in a downturn, that can impact you really in a significant manner. So you should not be making those mistakes, and that is the reason why you need to be taking professional advice. And the benefit of professional advice will always be seen in a down cycle. So, and down cycles will happen at some point of time, and you should be prepared for that. That would be my advice.
Sir, we have seen the Kotak has come up with a lot of NFOs recently. Is it a strategic decision for you as a CIO to be all the spaces, or is it just because you find opportunities in certain spaces and you bring a NFO to it? So, is it the Kotak's strategic decision that suppose if the global fund starts going up, we should have the fund there, and if Flexicap is doing well, we should have a fund there, or it is just that opportunity based NFOs which had come?
Clearly, we see opportunities in the thematic space, and that's why we have launched funds. Opportunities for the investors, when I say opportunities, because some of these themes or sectoral funds do offer a very different kind of an exposure. We spoke about manufacturing, for example. If somebody wants to take an exposure to manufacturing, while it is available in a diversified fund, but you also get a lot of other services like banking and financial services, IT services, hotels, and various other services, right? But if somebody wants to simply take only manufacturing exposure, then you should be able to provide that route to investors. Similarly, there are investors who are seeking for sectoral exposure more than what they get it in a diversified, for example, because at various points of cycle there could be opportunities either in terms of valuation or in terms of business momentum, etc. So only where we believe that there is a reasonable amount of clarity in terms of the business opportunity and the valuation comfort, we do go for some of these thematic schemes. And definitely, I mean, there is a need for that, because as asset management industry grows bigger, there will be different kinds of investors who come in and who have different needs, and as asset management companies we will have to deliver all of those products to them.
Okay. Sir, thank you for giving us this small podcast. I've been always a fan of Kotak, and under your leadership and Nilesh sir's leadership, I think Kotak will touch new highs. For the investors, I believe that they should believe the fund house which has performed for so long, the ethically managed fund which are more important, not just only the returns. If that theme of investor can continue, definitely they are going to bound to make money if the discipline investment and managing them ethically which there. Kotak has done it, sir, for years now, and the way you have supported the investors and the partners has been phenomenal. I think it is one of the houses which started educating the investors as well as the partners. Thank you for coming, sir, giving us this time. I am grateful that you have come to us and share your views on this.
Thank you so much, Romeo, and thanks for all your support and the kind words that you spoke about Kotak Mutual Fund.
Thank you.
Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.